Well, here's the big story this evening. India's current account deficit has soared to a record high in the second quarter. Rising trade gap took India's current account deficit beyond $36 billion in the second quarter of this financial year. The deficit has doubled from $18 billion in the first quarter. It is also nearly 4 times higher than the $9.7 billion reported in Q2 last year. With this, current account deficit for the first half of the fiscal also rose to 3.3% of the GDP. For the second quarter, the CAD is at 4.4% of the GDP. Well, to take this discussion ahead, I'm now joined by Aditi Nayar, Chief Economist at ICRA. Ms. Nayar, thank you so much for joining us. This is quite a startling jump that we're seeing as far as the numbers are concerned. 4.4%, unprecedented numbers. It's in fact even higher than ICRA's own estimates. Are you surprised? Are you shocked? What are the factors responsible?
Well, you're quite right. We had actually expected the current account deficit to be at an all-time high in absolute terms in this quarter. The range that we had forecast was $31 to $34 billion. So this is well above the top end of our range. But equally interestingly, the current account deficit for the first quarter has been revised downward by about $5 billion. So, I'm a little puzzled as to what to make of these numbers and really how to project forward. Because the Q1 number had come in below our estimate and it's been revised down further. The Q2 number has come in higher than our estimate. And I think at best what we are willing to say right now is that Q2 should be a peak as far as the current account deficit is concerned. Q3 at least, the merchandise trade deficit in October and November is trending lower than what it was in the previous quarter on average. And I think that's a positive sign. The other thing is that the services surplus in Q2 is actually very healthy. It's actually better than what the provisional numbers had suggested. So I think that's something that is a positive takeaway as we're getting into a period where exports are going to slow both on the merchandise and the services side. So broadly, we would expect the second half to see a current account deficit in both Q3 and Q4, which is probably going to be in the range of $25 to $30 billion. And for the year as a whole, we're looking at about $115 billion at this point in time.
Sure. Let me take this a step forward in terms of merchandise exports. That's the clear culprit here, going up to $83.5 billion. The question I want to ask is this gap that we're beginning to see increasingly going forward. Is it essentially on account of weakening exports or on account of perhaps pent-up domestic demand that is causing the import figure to balloon?
So there's both factors that are at play. The export number, we actually expect the monthly merchandise exports between December and March. So for these 4 months, we expect them to contract by 7% on a YOY basis. And it's both slower demand coming in from the major trading partners, as well as the fact that commodity prices have softened to some extent. So both of these will have a negative impact on the headline merchandise export number. And while lower commodity prices will help our imports, domestic demand is relatively more robust. And therefore, the volume growth or the value growth will both be higher than the export number. And therefore, the merchandise trade deficit is going to remain somewhat sticky. I would expect it to broadly be around, average about $25 billion per month in the rest of this year. And that might be a reasonable estimate to expect for the next fiscal year as well. How much the services surplus holds up is going to now be quite important in terms of trying to gauge the overall current account deficit.
Sure. Let's also look at the year ahead. You're talking about the next fiscal. The situation is not looking very positive in terms of the global performance and in terms of global growth. Can you give us a sense that when you look at softening of global demand, is that likely to, in fact, skew this figure even further, with exports suffering even further going forward?
That does seem to be likely. So basically what we expect is that the export demand is going to be weaker than our domestic demand. So that itself is going to lead to export growth being lower than the import growth. And secondly, with commodity prices trending lower, that's going to soften both the headline export and the import number. But that actually might help to bolster the domestic demand with commodity prices trending down. So it's going to lead to a trade deficit that's going to remain sticky on the upside. Don't expect the numbers to be as bad as some of the monthly numbers that we saw in Q2, when we did see commodity prices being higher than where they are right now. But I think an average of about $25 billion per month for the merchandise trade deficit is something we should be prepared for.
Right, Ms. Nayar, thank you so much for all your insights. So CAD likely to remain sticky on the higher side. That's the word coming in from Ms. Nayar from ICRA. But let's move ahead.